People in the U.S. who get their health insurance through their employers could be hit with a big price hike next year. Mercer's national survey of employer-sponsored health plans says that businesses across the country are preparing for the steepest increase in health benefit costs in 15 years, and an additional 6 to 7% in premiums. Consulting firm PwC says that medical costs for employers are also expected to grow. Cancer care and pricey prescription drugs are the top drivers of employer cost increases over the last 4 years. Now, that's not expected to change. All this comes as President Trump's cost-cutting agenda is impacting people on government-funded health insurance. Analysts say it's too soon to tell exactly how much Trump's so-called Big Beautiful Bill could impact Americans. All right, joining us now is Mark Pauly, a professor emeritus of healthcare management at the Wharton School of the University of Pennsylvania. Thank you so much for joining us. Really appreciate getting your expertise as one of the nation's top health economists. Workers, as I mentioned, looking at possibly the biggest jump in health insurance costs in 15 years. I mean, what is really driving this steep increase that we're seeing?
Well, we think the primary reason is it's a continuation of the recovery of healthcare spending and use of healthcare that obviously fell during the COVID period when the healthcare system was basically shut down, and the increase in use of hospitals for people with COVID was more than offset by a reduction in face-to-face visits and things like elective surgery for joint replacement and so forth. So at least the official government projections suggest that the highest growth of spending should have occurred in 2024. We don't have the official figures on that yet, but probably they're right, and it's bled over into 2025. So what we're seeing is the result of a sort of echo of the result of the depressed use of healthcare during COVID, right, for the most part.
Right. I mean, during COVID, as you say, I mean, companies kind of absorbed some of the rising costs to protect their employees. They're now passing more of the burden onto workers. I mean, why do you think there's been that change?
Well, of course, one thing is, as we know from last week's data, that the labor market is softening. So economists like me think that the primary way that people who get their insurance through their job pay for it is not in the explicit premium they pay, although that's going up too, but that's only about 20% of the total. Most of it comes out of the raises they would have otherwise gotten being canceled. And when the labor market was very tight, it was more difficult for employers to reduce money wage growth to pass on the cost of health insurance. So they ate it for a little while, but now that's all sort of a perfect storm, that the labor market is softening just as the spending echo is happening. Yeah. And the consequences of a surge, according to Mercer anyway, they tend to be more pessimistic than what actually happens, because they're asking employers about their anticipation of spending growth rather than the fact of spending growth. But the punchline is this looks like a pretty difficult year for workers having to pay for their health insurance.
Well, you talked about those sort of broader economic trends. I mean, the cost of many things are rising or expected to rise due to President Trump's tariffs. I mean, is that affecting healthcare costs as well?
Well, I don't think tariffs particularly are, but the overall economy-wide inflation probably is. Healthcare spending actually grew at the same or less than the rate of GDP until 2023. So the fraction of GDP going to healthcare in 2023 was about the same as it was in 2009. The projections are for it to tick up now to a rate of growth modestly in excess of GDP going forward after we get over this surge that we're seeing right now. But that's partly because of everything's more expensive, including the things that including labor healthcare is primarily a labor-intensive product, and including real products. The one thing that we have seen is that healthcare employment has been one of the bright spots in the employment picture for years and years and years. And sooner or later, if you're hiring a lot more people and paying them well, the price that you're going to have to charge for your final product is going to have to go up. And I think that's partly what we're seeing, a delayed response to the growth of employment in healthcare.
Yeah, bottom line is workers are going to have to compensate somehow for these rises that are projected, as you say, in their insurance costs for health. We'll have to leave it there, but really appreciate getting your expertise on this. Professor Mark Pauly, thank you so much.
Oh, sure.